Hello and welcome to this week's Market Outlook. This is Jeff Bish, president of MarketGauge.com, filling in for Keith this week. So last week I did the video as well, and I actually combined it into both the premium and the free into one video. Not going to do that this week, so let's get started with a two-part video if you're premium and the free video if you are just watching this as a free member. Welcome everybody. So last week I also titled the outlook, Will the Gauge Stay Green? This is what the gauge looked like last week. It actually improved during the course of this week. Those of you who are premium will be able to see that gauge throughout the course of the week as well, see how it holds up. The theme really for my analysis this week revolves around the fact that the markets, as you can see here, SPYs, Qs upper right, IWMs lower right, diamonds lower left, all punched above their 50-day moving average, which is this blue line. IWMs have been above the 50-day moving average for longer, and then so the SPYs punched again over it, putting them into a bullish phase, and now ducked underneath it. And that's true for the diamonds and through the Qs, or for the Qs as well. And this smaller, I want to call it a magenta line because that's what it is on my charts, is the 10-day moving average. So the big picture that I think you need to focus on for this week, maybe even going more forward, is whether or not these three markets can hold their 10-day moving average, and whether or not the top of this consolidation is going to serve as support or not. So they all pretty much have a similar look. The Dow a little bit weaker relative to that benchmark, and the IWM much stronger. So the IWM didn't even touch its 10, and it's well above this consolidation. That consolidation is going to come in at its 50-day moving average. We're going to talk a little bit more about the strength of IWM later on in the premium section, but for right now, that's the big picture if you're just looking at normal charts. Right? I also did a presentation this week on real motion, which happens to be on the bottom of this chart here, and one of the emphasis of real motion is that it confirms the ability for a market to take out its 50-day moving average and continue. It also enables you to see when the momentum of a particular market is actually going in potentially at the opposite direction, or is much more bearish or much more bullish than what the price action on the chart suggests. And unfortunately for the markets right now, we have that bearish situation in real motion that the markets are fighting. So going forward for the next, really, it could be a couple weeks, the question is whether or not the markets are in the process of accelerating on the downside in terms of their momentum. So just to give you a quick lesson in real motion, you can get this also, probably getting my emails for the replay this weekend. If you've got the blue line in real motion doing something different relative to the green line than you have the blue line doing in price, then you've got either a problem or an opportunity, and in this case it's a problem. So in other words, the 50 period moving average in real motion here, the blue line, is under the 200, the green line. So that's, if you were just looking at a price chart, that would be bearish, and it is bearish for your momentum. It's basically telling you that real motion, which is a measure of momentum that you can't find anywhere else, is negative, and you can see the effect that has on the price action. So what I mean by that is that if the SPYs broke above their 50 here, but they weren't able to break above their 50 on real motion, so the momentum is pretty much holding it back. Same thing happened here. Then the situation gets more bearish when it turns negative like that. So how do we get out of this funk? Well, just like with price, in order for this market to break the 50 and keep going in a more confident way, this momentum has to break its 50 and keep going in a more confident way. Now, if we get that, and we get a break of these trend lines, and you could do this on pretty much every market, then you've got a real green light in terms of real motion to look for the bull to really run. So you can't see it going back too far, but if you just look at the situation that we had at the end of 2017 in real motion, we had a situation where the blue line was crossing over the green line. The dots were all positive, so everything looked great. You can see it more clearly here in the Dow. And we got a market that went from, kind of moving higher to accelerating higher, right? So that's what it looks like when all systems are go. This is what it looks like when things are getting dicey. This is what it looks like when things start to turn negative in a really significant way. And so what does that mean? If we break down below here, then you've got price action pretty much, well, not pretty much, undoubtedly confirming that the momentum has been broken or has really turned bearish. We're not there yet. So for me, the analysis, the setup is really quite straightforward. We are in a very touchy zone between the 50 and the 100, sorry, the 50 and the 200 in price action because real motion is negative. We are in an opportunistic zone if we can break higher and have real motion move higher. All right, and we are in a super bearish zone if we get below the February or March lows, depending on what you're looking at. All right. Now you could take that same analysis and apply it to any ETF or any stock, and so some of the stocks are really falling out of bed, are in this bearish zone on real motion, and could be breaking below or already below their 200. All right. So if we take, we're going to look at some of the weaker sectors from this week, and the weakest sector, XLPs, is in this free fall zone that I'm describing here. This is the really dangerous zone. All right, so this is really by the theme for this week. That's what we're trying to assess with all the other indicators. It all gets summed up really nicely either by the price chart that you can see using the 50 and the 200, or if you've got the next level, real motion, then you can see what might be coming. And then we're going to layer in the other stuff that we usually do. All right, so I know that's kind of a long introduction, but I always like to look at the markets from, what's the premise, and then what's the evidence in the market outlook or the big view product that will help give me some insight into whether or not that premise is likely to play out, or it's premature, or it's just a totally mixed bag. All right, I think we have a pretty balanced view, as you'll see in a second, for this thing being able to go either way. But right now we're on that inflection point of if it breaks to the upside, it's a pretty significant bullish scenario, and if it breaks down, we're in kind of purgatory until, like I said, we make new lows, and then we're basically, well, you know what happens after that. All right, so the Qs, same spot as the SPYs, right? In pretty much all situations. The Dow a little bit weaker because it's a little bit further under its 10. It's kind of eaten into this consolidation already. And the other thing that concerns me about the Dow is that its April low fell below its February low. So the Dow, by a number of accounts, is weaker, and actually you can see the momentum is a little bit weaker as well in terms of real motion. But IWM is the standout here, right? IWM, this pullback has remained on top of its 50 in real motion. That's what you like to see. As I pointed out, it's just sitting on its 10-day here, and it's spent a week and change over that 50-day. It didn't just tuck up to it and then fall. All right, so in March, where Qs looked like they were going to be the leader, Qs now have taken a back seat to IWM since let's call it the beginning of April. All right, so with that, let's take a quick look at the weekly situation, because the weekly situation is one of the reasons why we might expect that the upside here is actually pretty bullish. So if you look at the weekly real motion, this is just beginning to turn bullish. So if we have all this consolidation, whole like first quarter of consolidation that then turns higher and real motion on a weekly basis, not just confirming over the 50, but actually have the blue and the green going bullish, this could be the beginning of a significant move higher. All right, but like all inflection points, oftentimes those areas that could be the beginning of a really big move one way also represent the possibility for a really big move the other way. So one way to look at that from a pure technical point of view is this is a tightening spring on a weekly basis that could really break either way. Now, they don't all have that same triangular look as the SPYs, but you can still look at the markets on a weekly basis and say this type of consolidation we really haven't seen. It's wider, so that's not really a bullish sign in my opinion, but we haven't seen that type of consolidation for that type of length since areas kind of like this, if we look at the Qs, right? So the wideness, the volatility of it doesn't really bode well for a really huge bullish breakout that's extended, but the consolidation does bode well for a market that will continue one way or the other once it breaks. It just might be a messy continuation. All right, so weekly paints a slightly different picture in terms of the bullish or bearishness. I put the weekly picture as being bullish, but the daily really has to get out of its way for right now, if that makes sense. All right, now let's take a look at some of the key ratios here. The utilities moving up over the ratio of the SPYs versus the utilities. This is bullish when it is positive. And if we look at the additional key ratios, they're all still positive, right? So one of the things I would watch out for if the market were to move lower is that if all of these flip to negative and this continues to go negative, that's definitely not what we want to see as the bulls. Now, in terms of the volume, I think the thing to really point out here is the accumulation days and the distribution days. The distribution days have moved up, but they're basically equal. So I'm not going to read one way or another into this, but during the course of the week, keep an eye on these distribution days. If we get to 4 or 5 of these, it's not what you want to see. That would lead to a more bearish belief. So if we just take a look at the sector page, and I'm always referencing this as I've been writing for Mish's Daily. Mish will be back on Monday. Keep an eye on this sector table. All right. Now for the week, what I think you need to do for this table today is look at what happened this week. So the last 5 days, semiconductors have really been the dog. Now that really has happened over the last 2 days, but semis have really gotten smashed, and we're going to see why in the premium section here. We'll look at the semis in terms of their real motion and their triple play. So semis getting smashed is not really a good sign, and we've also got the consumer staples got smashed. So I want to point out though, consumer staples has been the worst performing group for the year, certainly the second worst until this week, and then it kind of took over for being the worst. And if you look down into the consumer staples group itself, like Philip Morris and Procter & Gamble, I mean, I'm quick to point out when it's just the biggest one that's dragging it down, but that wasn't the case in consumer staples. Everything was just really had a horrendous week, and a lot of those, if not all of them, also had negative real motion going into the week. So that's just an ugly looking group right now, and it also happens to line up with one of the areas of the market that tends to do worse late stage. Now, maybe this is due to the rates, and we'll talk about that coming up as well. The other one that I think you got to watch out for is the XHBs. They were down on the week, and on a technical level, if you look at the XHB and you look at the ITB as well, which is the home builders, not just that doesn't include the stuff like Lowe's and Home Depot. Technically, they're really pushing on that 200-day moving average, and if they break down, it's going to be ugly for that group. So watch that group as well. Now, on the bright side, energy continued to move higher, and financials held up well. All right, so financials, again, we'll talk about a little bit later, and transportation held up well. So financials, transports, if we can get these to hold up and move higher, we'll have some healthy sector rotation, even if we're losing the consumer staples, and maybe all the staples have to do is bounce, and there's a scenario where the market continue to grind higher. So keep an eye on this chart, because what you want to see is if the market does pull back into this neutral zone, you want to see that this holds up. You don't want to see a situation where it starts to fall apart like it did down here, right? Now, down here, like if you read the text below here, the way to use this chart is really to figure out whether or not this 200-day is going to break. And if you've got these groups down below this 3 line and you're breaking the 200, you need to heed that warning, all right? That is very, very negative. I would argue that one of the reasons that the 200 held up so well here is we really had good strength across the industry groups. It held up here. We had good strength across the industry groups. If the industry groups, pull back, I'm going to say even to the 5 level. I know 3 is our benchmark, but if they pull back to the 5 level and we're breaking that 200, I know I'm going to be hitting the negative button. All right, so that's pretty straightforward. I'd say that's your homework for the week. If you're a free member here, keep an eye on all that stuff. Sorry this is so long, but I hope that helps, and I will turn you over to Keith next week.